Welcome back to Morning Markets on Friday the 20th of October. The US economy is demonstrating some real resilience. Who's saying this? Well, it's not the analysts or the forecasters, it's corporate America and the policymakers. Stay tuned with me for a few moments and we'll discuss some of the detail. Let's start with some numbers. Economic growth on an annualised basis is trending at 5.4% in the current quarter in the US. Unemployment is near the lowest levels which we've seen for much of the last 20 years at 3.8%. We're seeing wages which are growing around 1.5% above headline inflation. And the 80 companies of the S&P 500 have so far reported, so far so good. They're seeing earnings growth of around 1.7%. That's around 6% ahead of analysts' expectations at this point in time. So if we're seeing all this positive news, then why is there still volatility within the market? Well, one of the aspects of this is the strength of economic growth is giving the Federal Reserve, the policymakers around inflation, the confidence that they can retain interest rates at their current levels, at the higher levels which they're currently at, for longer in order to bring inflation down to that 2% target without concern of breaking the economy. Yesterday was a good example of that. We had Jerome Powell, who's the chairman of the Federal Reserve. He spoke at the Economic Club in New York yesterday ahead of the blackout period which sits before the November meetings. In the session, he was talking about the strength of growth, the demand for employment at this point in time from businesses, but demonstrating that this strength does present potentially a headwind to that disinflation, which is the slowdown in the rate of inflation, which is important as they're heading towards that target of 2% at this point in time, and demonstrated that if they see continuation of this, it might mean that they require to hold interest rates for longer and wouldn't even rule out raising interest rates additionally at this point in time. However, this more hawkish tone was softened later in the statement when he did recognise that the work which they'd already done in raising interest rates, the rise in bond yields, which we've seen driven by the market, is in effect having the impact of tightening financial conditions at this point in time, which in itself should moderate the effects of growth and therefore inflation and support them in their objective of getting back to that target. Despite this, we did see a slight uptick in terms of bond yields on the day, which had an impact on bond returns, the equity markets, but also the currency markets as well. We're also seeing this evidence of a strong United States economy on the ground. A number of corporations reported yesterday. Take some examples here. Marsh & McLennan Insurers reported a 13% increase in sales revenue. They also reported a 34% increase in terms of their net income, seeing strong demand from their insurance arms, but also their consultancy arms. Netflix, they demonstrated the benefit of tightening the ability for users to share passwords across accounts and use have access to multiple users to accounts. Here we saw an uptick in terms of the subscribers in the quarter. It was actually the biggest uptick which we've seen since 2020. 9 million additional subscribers. They've now got 247 million subscribers globally across their platform, and their earnings were 6.5% ahead of analysts' expectations. So a lot of reasons to be positive there in terms of the economic growth, but it's important to recognise that what this does is it does present a challenge for the Federal Reserve in terms of their disinflation targets. As it currently stands, we are seeing disinflation and we are seeing moves towards that target, but we've got to be aware of what the policymakers are telling us at this point in time. Thank you for watching. Enjoy the weekend, and we look forward to bringing you up to date on Monday here on Morning Markets.